Well, welcome to a brand new live streaming program here on WLOX. It's called Expert Alert, and this is our inaugural show. We're going to be doing this every week with different businesses along the Gulf Coast and their specialties, talking about things that, well, they are experts on, so they can help you out in different things. And we're starting it off here today with Strojny, the financial services here on the Gulf Coast. Jennifer and Carrie Milligan. Jennifer is at the Biloxi location. Carrie, your husband, is at the Gulfport location. And we're going to kind of kick things off with something that is very important to people right now. With the COVID stuff going on, people are getting the relief checks. Some of them aren't getting the relief check. So they're wondering, I didn't get my stimulus check. What can I do? What do you say to that, Carrie?
Yeah, so Jim, that's a very frustrating part for a lot of people that didn't get their stimulus check. And unfortunately, there's really nothing you can do right now. However, you may be able to file that, at tax time when it comes. So, if you meet all the parameters and facts as it stands now. Now, we have found, like everything throughout this COVID period, things are kind of fluid and could be subject to change. But right now, it looks like they may be able to file that on their 2020 tax return.
Now, here's the question that I had. As soon as I got mine in the mail, I looked at it online. I wonder if they're going to tax this. Is it taxable?
No, it will not be included in your taxable income at all, or gross income either. And no, that's not going to happen.
Okay. I had a dependent on my 2019 return that qualified me for the extra stimulus check. This was a question that we had gotten. They aren't a dependent in 2020. Will I have to pay that part back?
That's an excellent question, Jim, and we've had to look at that. And as it stands now, as we've done our research and had a Q&A with the Internal Revenue Service, it's no, you will not.
Okay. Jennifer, another question. I got the $10,000 economic injury disaster grant. There was so much money that was been sent in on to help people out individually, business-wise. Is that taxable?
Yeah, so there's a lot of confusion because there were several different federal laws passed, and then the state got some money. So there's different grants and different programs. So this particular question is about the economic injury development money and disaster money. Okay, so that money was designed, there were two pieces to that. The first part was a grant, okay, that you could apply for, and it would either be, depending on how many employees you had, somewhere between $1,000 and $10,000, okay?
Right.
The grant is taxable. However, there was additional money available on top of that. So they were rushing out the grant money to get it in people's hands so that they could pay staff and open back up and survive. But then they had additional loan money under that same program, different than the PPP. Payroll Protection Program, two different programs. So anything that was above that $10,000 or $1,000, whatever you qualified for, is the grant. The grant is taxable. Whatever's above that is a loan that you will pay back, not taxable because it's loan proceeds. So hopefully that clarifies a little bit because there's a lot of moving parts.
Well, I mean, there's a lot of different monies that were coming out to people on individual business basis for businesses. To help out during this time. Here's another one. My PPP loan was for $25,000. I spent it on payroll, utilities, and rent.
Yeah.
What happens after it's forgiven as far as taxes?
Okay. So PPP is the Payroll Protection Program.
Right.
They have a forgivable program. Now, some of this is in flux right now. Even since we got these questions, things are changing. There's some legislation out there right now that says if the PPP was less than $50,000, that's under the HEROES Act, I think, that's going through right now. You're not even going to have to turn anything, and they're just going to automatically forgive, which would be wonderful if they pass that. And then between $50,000 and $150,000, there'll be a short application, but you won't have to provide all the documentation. Now, this legislation has not passed. But if it does, that's going to be very helpful to people because we've already started doing some of those forgiveness applications, and it can get pretty techy and tricky. But to answer the question, so the PPP money is a forgivable loan program. They are not going to have you include the proceeds in taxable income, but you cannot deduct the expenses that you paid for with that money. So I won't have to put the $25,000 on as income, but I also won't get to deduct that $25,000 in payroll, rent, and utilities or whatever expenses it was that they had there. So if my income was way down because of COVID or for whatever reason, this probably isn't going to be a big deal. But let's say my sales were stable, I got this money, and now I have payroll deductions I can't use. You may still have a tax consequence there. So that's something you're want to get in front of your advisor or really do your research on, because it's going to be very unique and individualized to the person. Now, if you have a piece of PPP that's not forgiven, again, it's loan proceeds, so not taxable.
Wow. A lot of things to understand.
Excuse me.
Go ahead. I noticed my paycheck was bigger this week. My employer said they are waiving my FICA taxes. Is this going to create any issues for me in the future?
Yes, it would. Yeah. So what this is the payroll holiday, they've called it, so-called, or really it's a deferral system. So what it's doing is for the fourth quarter, the employee is allowed. They're not taking out payroll taxes from them, the FICA, Social Security, Medicare, and the employer is not having to match. So they're taking that off to help through this time, through the economic downturn. However, if you opt in, and your company has the choice to opt into that or not, and then you can talk to the company on an individual level and talk to them about it, because what will happen in the first quarter, they will start taking your Social Security, Medicare. Everybody has it come out of their W-2 right now. I mean, you see it on your W-2, it comes out of their paycheck. Well, they're going to take double, to make up for the fourth quarter.
Wow. And
the employer is going to have to do double. So really all it is a deferral, right?
So if I find out that my paycheck's more, and I find out, I can go and say, don't take it out.
Right.
They'll do that?
Well, it's the employer's option. The employer opts into the program or opts out of the program. I don't know if they've added something that allows the employee to have a choice, but right now when it first came out, it's at the employer level.
Okay.
So you're either in or out. What you need to know as an employee is that if your paychecks are bigger now, you probably want to put some of that aside, because they're going to be that much smaller than normal, not just smaller than this, but smaller than normal coming into first quarter.
Oh, wow. And you don't want that sticker shock, so to speak, when that happens.
Well, and again, legislation's out there for all of this to become forgivable or
it could change. It's very fluid.
It's in flux.
Right.
All right, here's another question. I heard I don't have to take my RMD for 2020. Is that true?
That's true.
Okay.
That's absolutely true. So RMDs are required minimum distributions, which the IRS has you take, individuals take that out of their individual retirement accounts or qualified retirement accounts at work if they're no longer working.
Right.
They're required to take in some beneficiary IRAs that have been inherited. So that had been, normally you would have to start taking them after 70 and a half, and earlier this year there was the Secure Act that was passed that moved it to age 72 because we're living longer, right? So they were going to raise that. Well, COVID hit. They said everybody, doesn't matter if you're 80, 90, 100, no one has to take it. Now, if you need that to live on or want some money to come out of, you still can do that. However, it's nice for people that don't need it, that have to take the money out, to be taxed on. It's nice for them to be able to leave in there and let it come back as these markets have grown back over time.
Okay, he got one more question for you.
Sure.
I took a hardship withdrawal from my 401k because I was out of work for several months due to my employer shutting down due to coronavirus. They didn't hold any taxes. Does that mean I don't own any?
No.
No.
So here's the deal. So they did pass under the CARES Act some different legislation about hardship withdrawals out of retirement because of COVID. They wanted people for exactly this situation. If you're out of work, if you're having to take off to caretake for someone, they didn't want it to be a big burden on the individual American person. So what they did is they said, okay, in this situation, you can take it out. You will have federal income tax on it. That's not an exception. This was tax deferred money as you put it away. You got that tax break, so the tax is there. The penalty is waived. So there's a 10% early withdrawal penalty. You will have that waived. And you will also have the ability to spread those payments out over 3 years to pay the tax in 3 installments. So if I took out, I don't remember the amount, but if I took out $100,000, I can do $33,000 a year on the next 3 tax returns. And what that is going to do is maybe it keeps me in a lower tax bracket than if I put all $100,000 on the first year's return.
And let me just add to that, Jen, if I may. Mississippi, though, as of our last conversation with them, is not doing the same thing as the Internal Revenue Service. So it may all be lump sum taxable.
rebels here.
Right. So hopefully they come and do something as well, because that would be nice to take the burden off the taxpayers. But there may be some tax consequence all in 1 year for Mississippi.
Exactly. Usually when there's a federal penalty waiver, Carrie's exactly right. You don't pay. Mississippi is a great state for retirees. They don't tax that income.
Right.
But they said in this case, because it's not a normal penalty exception, that they haven't done anything with that yet. So as of right now, it's taxable to the state.
Right.
So don't think there's no tax. There is federal and state tax as we speak, but there's no penalty, and you can spread that federal tax over the 3 years.
That's good. All right. Thank y'all so much for being here on the show this morning. And of course, if people want some more information, of course, you can go to their website, find out exactly other questions that you might have regarding any of this or any financial questions. And this is going to be continued, because you'll be back next month.
We will.
We'll have another topic to talk about on Expert Alert here with Strojny Financial Services here on the Gulf Coast. And if you'd like some more information from them, you can set up an appointment with either one of y'all, Gulfport, Biloxi, or any locations, and get some help. But again, thank you for being here on our first inaugural show of Expert Alert here on WLOX.